Hello, everyone. It is 12:02 p.m. Chicago time. Thanks for showing up and listening to me. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. This is another Ask a Question or Ask Me Anything webinar session. This is FuturesTrader71. The panel you have in front of you for GoToMeeting allows you to interact with me. There are some rules that we need to stick to here to make sure this process is orderly and people's questions are addressed. This is open to the public, meaning it's open to non-stage 5 traders who are willing to listen. But normally this webinar occurs every Thursday for stage 5 members so that we can address issues. And we take this opportunity, and I have done this publicly in the past. If you look at my video archive on my website, FuturesTrader71.com, you'll see instances where I came on and did a live intervention on someone's trading, assessing what they're doing wrong and doing my best to help them by using the experience that I gained as a prop shop owner and somebody who backed and developed traders. So here are the rules. Priority is always given to participants who are willing to grab the microphone. If you have a headset or a microphone on your computer and you want to ask your question by mic, I always prefer this. It makes the conversation much more dynamic and much more in depth, and that's important. And also, it allows me to extract more information from you to give you a more intelligent answer to the best of my ability. One question per participant only. And yes, this webinar is recorded and will be available to S5 members. It says here for 2 weeks. I should have edited that. These public webinars are actually going to go to YouTube, and they're available there until we take them down at some future date when nobody's watching them. If you need to get a hold of me, just so in case I forget to post this, info@futurestrader.com. FuturesTrader71.com, or just go to my website and hit the contact button. If you're interested in stage 5 services, I'm associated with stage 5 in that I'm the head of trader development here. I also watch risk, and I do my best to keep traders in line. I often find myself calling traders and telling them to stop trading, which is not a common thing in the brokerage business. Generally in brokerage, your broker wants to give you the lowest margin possible and have you trade as much as possible. But in my opinion, and the vision that we've had since we started stage 5 trading a few years ago, our vision is to shoot for the long term, to help people stay in the business, stay trading as long as possible by preventing blow-ups, over-leveraging, and providing some sort of structure to support their process. Again, info@FuturesTrader71.com. So, questions are already coming in. I've got a mic request from Alex. Let's go straight to Alex. Now, incidentally, my intent for this webinar is to do something different. I actually loaded my live platform. This is actually live. This is my live dome here on the S5 Trader. And this account is my test account. It has, I don't know, maybe $10,000 or something like that, $7,000 or $10,000 in it. And the idea was to, when I planned this webinar for today, last week, the idea was to go from soup to nuts, meaning to set up where we are at midday, what we have done so far, what the market is saying, and to set up and take stock and talk through a trade, which doesn't happen often in our business, but it's something that I would do in front of my traders all the time. So I thought I'd do that live, but I have to say that I could not have picked a worse day for this. This market has not done anything. The primary hypothesis for today, for those of you who caught the Trader Bite video, Trader Bites are a live streaming video that I do in the morning pre-market at 8 Central, 9 Eastern. It's announced on Twitter, and I go over the what's driven the market overnight, news that may affect the trade, and I lay out what my plan is for the day, the key play of the day or the trades of the day. Hypo 1 being the highest probability play, and today's Hypo 1 was just as you're seeing here, a choppy open. And of course, you can always go to YouTube, just look for FuturesTrader71, and then look at the videos in there, and you'll find today's Trader Bite. And today's Trader Bite basically outlined a push, a sideways choppy trade on the open, and then the expectation is for a push higher to fail, roll over, and the target is 87.75 right here. So it's taken forever. The context for that trade has not changed. The idea was to get on and hopefully find it somewhere up here and failing back in, stalk a short and take the short back through the OS, through the IB low, and then back down to 87.75. But it just looks fairly dead. I think if I put a trade on, it would probably take an hour and a half to get 2 points out of it right now. Anyway, let's go to Alex. Alex, you're on the air.
FT?
Hey.
Hey, how you doing?
Good.
So my question would be, I observed you and another experienced trader in the chat room looking at different sectors. So I was wondering, I mean, I do know we're trading an index product, but what's the point in watching the different sectors, and is there any way to gain an advantage through doing that?
Okay, so Alex, for the first thing we need to do is, so we process a lot of information as we trade, and some information is what I would call tier 1, or in the analogy I used, I don't know, in several webinars a couple years ago, if we were putting down a foundation for a building, we would want the most stable foundation as possible, and so we would put big boulders down, like think the old days, not concrete and steel, but back in the old days, you would want to put big boulders, and those boulders provide the strength for that foundation. And then we would want to take smaller rocks and fill in the space. And we want to take even smaller stones and stick them in the space, and then fill in the gaps with dirt so that you have a nice stable foundation. Can you imagine that, right?
Yes.
So the big pieces of information are boulders. I call them boulders. They're like the foundation of the day. Things like
tier 1, that would be.
Yeah, that would be the tier 1 important stuff. Things like, where are we auctioning compared to yesterday's range, right? Yesterday's range high is right here, this green right there. Yesterday's range low, this is RTH only, is the green down here, the green line down here. Where are we versus the point of control? Where are we versus value? And where are we versus yesterday's close? And yeah, again, the point of control. Those are important things. Are we opening up high and gapping, and we're failing to go high and we're starting to roll over? That's a big indication. Have we opened near the low, pushed one way, and then broke out back into the range? That's another big boulder. Can you hear me, Alex?
Yes.
Okay, that's another big boulder. So these are important pieces of information, and they're driving the trading, right? How is this behaving? Like when I look at my trigger chart, how is this behaving on the rotations? The quality of the rotations is very important. When I read the rotations today, chop, 2 points or so, all in here, and then suddenly we get a large rotation up, 3 1/4 points, and then a pullback of 2 1/4, then a test of a point, 1.75, then we have a drop of 3.75. So far, up to this point, the largest rotation is a down rotation. And then how how does that continue, or is it rejected, and so on and so forth. That's another big piece of information. As far as the sectors, they're important to watch because they're driving the stocks that are underlying the S&P 500, and it's a stock-based index. It's an equity index. And if you go to Standard and Poor's website, I don't have that in front of me. You will find that they outline the different pieces that go into what the S&P is made of. Okay, and here's the sector breakdown. So this is an important website to bookmap, by the way. Let me post it in here for everybody so I'll go to Alex, post it for everybody so that you all have it. This is an important website. It's adjusted every once in a while, and you can see as of the 31st of July. And these are the key sectors: technology, financials, healthcare, consumer discretionary, and industrials. Take all of these combined, and they represent approximately 70% of the S&P 500. And here's the chart that tracks them. Here's the quote board that tracks them: technology, industrial, financial, healthcare, and consumer discretionary. Just like the website says, right? These top 5, I'm tracking the top 5, and they are right here. And these are sorted by worst or lowest gain or the biggest loss to the most positive. And so I keep an eye on that. You'll notice that I write about that in the chat room or on Twitter in the morning. I say financials are dragging and so on. And I have an idea of how much of the index these represent. On this chart here, this chart starts at 0 at 8:30 Central, right when the cash market opens. The dotted line here is 0, and these are percent lines. On this chart, the ones that have the dashes, they're the 5 sectors. So here you have the industrials, you have financials down here, you have the consumer discretionary stocks down here. Underneath them, you have technology, and then you have healthcare right here, flat. And I'm tracking how these move. If I showed you yesterday's chart where it was balancing down below, it's balancing, it came out of yesterday's range, and it was balancing below. Let me pull that up here. You'll see how important this is. So if I go back a day.
You mean where it compressed under the low?
Yeah, like yesterday, we had that compression down underneath the prior day's low. Let's look at that for a minute. So here's yesterday's trading, and we opened, the expectation yesterday was for it to open somewhere in here in the 82 area, push up to 80, 85, 86, then fail, and then break the prior day's low, which was Friday's low, and then start to make its way down to 66. And what it did is it opened and it went through yesterday, the prior day's low, Friday's low, and it compressed. And while it was compressing, the delta was rising and rising and rising and rising. Well, at that same time, you can see here the transports, which is the orange, which is another big thing that I watch. So let me zoom into this chart to show you the example right at the open. So you can see here these stocks. So this is the industrials, and the one that I think is a real driver is healthcare. So you can see healthcare is selling off early on, and then it turns up, and then it finally gets positive while the transports are still going down, while the market's still sideways, and it starts to get positive, pull back to 0, and then it takes off. This is when the market turned, and you can see the transports start to rise. And on this chart, this is, I think this is the S&P. It's obscured. No, that's the Bund. Where's the S&P? The S&P. So this may be the S&P. Anyway, you could see it turn. You could see everything turning up. You could see these underlying sectors all going up. These dashed lines here, all starting to rise with the market as it turns. It does not indicate that I should get long, but it tells me the health of the move. You know, how big a move are we likely to get? How serious is it? And this is what's important to me. It's not much more than that. It's really just about who's contradicting this move. You know, which part of the market. So this is today's chart. You can see that from the beginning, the Russell here is leading the move down. So it gives me an idea of the relative relationship of these products. There's oil. Here's the black is oil. And it shows me what's happening, what's leading the move down, what's leading the move up, and how is everything corresponding. So on this chart, I have the Russell, Euro stocks, DAX, NASDAQ, transports, and then this guy is the S&P, the green, and then we have the S&P sectors that are dashed, the dollar index, the euro, the Japanese yen, the Dow, the 10-year bond, gold, and then crude is at the top here right now.
So since yesterday they all converged, would that imply that you trust more in yesterday's move?
No, this chart restarts right at the pit open and starts from zero again for today. So it does not represent anything from yesterday, but what it showed me about yesterday is that the move was heavily supported. I don't want to pull up that chart and reload that chart again, but it shows that once the break higher happened, once this break happened, it got a lot of the underlying sectors pushing with it. Another important chart is the S&P breadth. This was the S&P breadth yesterday. Breadth is measuring how many stocks are positive or moving up versus how many stocks that are negative. And you could see the breadth, the overall market breadth was also supporting yesterday's move as well. Today, not much. It's just sideways. So today is really a short-term trader type day, mean reverting type trade so far. Okay, does that answer your question?
Yes, thanks a lot.
Thanks for asking. All right, so let's take your questions from the top. But since I don't know the audience here, I want to take a moment just make sure that what I'm talking about here is relevant. We have a lot of time, at least I do, and I want to make sure that we address as much as possible. So I have some questions for you just to get an idea of who you are and what I'm dealing with. So here's a poll. I'd like you to quickly answer. I'm going to give you about 30 seconds to answer this, just so that we have an idea. Just to put in your vote, just click on the button in front of you. Unless you're on a mobile device, I think mobile devices don't respond to these too well. So it's been 30 seconds. I'm about to shut this down. Wow, the majority of you have been trading for more than 5 years. That's awesome. The next group is 2 to 5 years, and then after that, 1 to 3 years. Very few are new to the business. So let's close that poll. I have a second question for you. Here it is. There are 6 questions in total, and this gives me an idea of who I'm talking to, and then I'll try to address your questions from that perspective so that it's the most relevant possible. So just take a moment. This shouldn't take long, only a few minutes. So far we've got 50% of you who are attending here voted. 30 seconds. Greg is saying, well, we need an option for still figuring it out I'm talking about your current state. I'm only interested in the present moment. Where are you in the present moment? If you're not participating at all, meaning you're not trading at all and don't know if you're consistent or not, then don't answer. It's okay. All right, that poll's been up for a minute. I'm going to shut it down. I've got 78% of the vote. Some of you are shy. So on this one, it shows 36% of you are neither losing nor gaining. The next strongest category is I'm consistently losing but slowly. The next strongest category is I have spurts of great trading and then taking big losses and then take big losses. That's a big one. This is one of the main reasons I created Stage 5. And then the next group says yes with rare setbacks. So that's awesome for those guys. And then only 4% of you are saying I can't seem to do anything right with trading. So I'm pleased to hear that. Next one tells me where you are in terms of how you're setting up your day. And this could include your sim results too. That's fine if you're only simming. We want to know where you are. So it looks like the question is, do you set daily, week, should have said weekly or monthly goals? 38% of you so far without fail, 52% say sometimes, 4% say no, it's a waste of time, and 7% haven't thought about it. 70% of the votes here. All right, I'm going to close this down as well. Thank you for voting. And then I have a couple more. This is an important one. Do you think it's possible to make a living at trading? Try to answer this one at least, please. The last question, Prakash is asking goals for what? Goals for what you plan to focus on or achieve that day, that week. And it can be a dollar goal. It could be eliminating errors, improving on a certain aspect of trading, becoming aware while you trade. The goal could be anything. It's not necessarily dollars. So 84% of you have voted and 98% of you say yes, 2% of you say no. Very interesting. The 2% is definitely lower than I expected. I expected many more pessimists because this trading has a tendency to just beat it out of us. It's a very difficult endeavor to take on. It forces us to really change in order to see some results, in my opinion. And that's what the Trade Wisdom segment was created for. I'm going to skip this next question. I'm going to go to the last question because this is getting a little bit long and I don't want to bore you. This, you can select multiple answers, but two. Keep it to two, please. Only select the top two that might match what you believe is the right answer. Select two items that would help your trading the most. What two items you think would help your trading the most? The options are more capital to trade with. The second option is a mentor to provide feedback and guidance. The third option is better software. The fourth option is better indicators or signal system. And the final option is a trading therapist. In other words, someone who can handle the performance psychology issues, therapy, and things like that. 80% of you have voted, 52 seconds into it. I'm going to give this a few more seconds just because this is a really, really important poll question. And as soon as the voting stalls, I'm going to cut it off. And looks like voting has stalled. Okay. So the result for this should be coming up on your screen. The overwhelming majority believes that a mentor to provide feedback is the biggest thing that can help their trading. Did you know that? Did you expect that? That's what's important. And of course, more capital to trade with, except the caveat is, if you get more capital to trade with, does that mean there'll just be more losses? Is there an edge to your trading? Do you even know? And then the third top result is a trading therapist. Very few feel like you need better software or better indicators. So in my opinion, these are pretty good answers. Pretty intelligent crowds what this says, because you're not paying attention to the sales gimmicks of you need this indicator, that piece of software to do better. So I have a better idea of who you are. Let's finish going through the questions here. Jason popped his first question in right when we opened the webinar. It says, can you please talk about knowing when an auction has been completed? So an auction that is complete has a lot of balance in it. So when we look at a trend like yesterday, coincidentally we had a trend day yesterday. When we look at a trend, what you will see, and you don't see this on bar charts, and this is why I moved from using pivots, floor pivots, and so on, and moved to market profile, and then that didn't make a lot of sense to me to stay with market profile, so I moved to volume profiling. And the reason is, in the bars, I don't get to see these voids. So when we look at yesterday's auction, we see that there are areas that just hardly traded at all. And that's common in a trend day. So what you have is from here to here, this area never saw a counter rotation. If it did not see a counter rotation, then it's likely to be tested again. And the reason it's likely to be tested again, and I've seen this over the years over and over and over, is because we don't know who's on the other side. So as price moves up, price does not move up because there are strong buyers or more buyers. There are more aggressive buyers, but there are never more buyers than sellers in futures. Never. Every contract is an agreement between a buyer and a seller, and there's an infinite number of contracts theoretically that can be created. And a price can move from here to here on one contract. We could trade one contract and have price move 5 points. It's possible. And so what you have here is potentially the offers being pulled and bids reaching higher to trade, and the volume could be very low through this process. So this is why you have to combine price with volume, because price on its own is not telling you the full picture. Much like your weight does not tell me how healthy you are. There are other factors that have to be counted in or measured for us to understand how healthy you are as a candidate for, say, an athletic sport. What's your blood pressure? What's your lean mass? Things like that, resting heart rate, and stuff like that. So for an auction to be complete, what we need to do is push through and then retest the levels, and then push through and retest the levels, push through and retest the levels, and there's always overlap. There's just constant overlap. That's a much more orderly auction. A more panicked or high-speed auction tends to do what it did yesterday. So what that leaves us with is our target for today. It leaves us with these low volume nodes that are likely to be tested, because we don't know what the participation is like in those areas. So the market generally pulls back to these, and that's what's expected for today, is to pull back into 87. I'm not expecting more than 10 points of range today, but it's expected to push through 87 to test this area properly and for the auction to be complete for this particular day. Now, If it does not hold the 87, then the next target becomes a high volume node because that's a price of agreement. So the next price down becomes 85.75. And once it gets to 85.75, we'll probably see rotation. And then if it starts to break lower, then my target's going to be the other side of this low volume node. It's likely to fall right through and fill this back in. And that's what brings us to a more complete auction. I hope that addresses your question. Let me check again for mic requests. I don't see any. Okay, next question, Christian. I have a question about your stop management. Do you use trailing stops and or take profits? If so, at what distance? What is the effect of the theoretical average to stops? Greetings from Germany. So the first question, use trailing stops. I don't use trailing stops. It's not what I recommend, though. I'm not recommending that you do not use stops or trailing stops or hard stops. Just being, I have never as a professional trader, always trading in a professional environment with high reliability lines and connectivity and so forth. What's happened with putting stops out there, for me personally, again, this is not what I'm recommending to you, but what happens is I have a tendency to become passive when I put a stop out there, a hard stop out there. Also, as you develop as a trader, you start to control your risk with size. In other words, you start to manage your risk by manipulating your theoretical average. So let's say I'm still playing Hypo 1, which has a target down here. That's our Hypo 1 target, and I see that the market's finally pushed through the mid. So my play is to catch any pullback to the mid to get short, and it happened right here actually. 96.50 right to the mid, and I'm looking to take a break lower. So let's say my play is to get short this 95 quarter with the last high being 96.50. I do not put a stop at 96.75 or 97. What I do is I look for, okay, what's in the way? How much more easily can it rotate down to the IB, which is our main, I'm going to ignore the opening swing high and low because we have tested it and retested it. It's no longer valid really for this session. But I'm going to look for how far is it to my main obstacle, my first main obstacle, which is the initial balance, this yellow line, versus where I would be wrong, which is way up here once it gets out of the opening swing. So at 95 and a quarter, I'm assessing that I have about a 2 to 2.25 point distance till my idea is wrong, that this market is not prepared, and then down to the IB from 95 and a quarter or so, I have approximately 2 points, 1.5, 2 points to the target. My profit, my risk-reward ratio needs to be at least 1R. I have to have at least one unit of return per unit of risk, and I need to have that over the long term because I'm not a trend following trader. I'm not a trend trader that's going to catch a 30, 40 point run in the S&P. That's not my game. So this gives me about a 1R. And so what I do is I take the short and then I look to scale out before the IB, knowing that this is a very balanced day. See how it's Gaussian? This profile is very balanced. I'm going to look to get out before the IB, but because it's a mean regression type of day or mean reverting type of day, I'm not going to overstay any trades. So I'm gonna dump a lot of my size or the quantity that I'm trading. I'm going to dump it before the IB. I'll probably play a tick instead of 2 ticks ahead of the IB low, which is at 92.75. So that gives me a 1.5. Is that a 1.5 or 2.5 points? from 95 and a quarter. Yeah, it's about 2.5 points. And what it does is if I dump half of those contracts out, then it basically brings my theoretical average to about 97 and a quarter. So now my theoretical average, which I track with the trade analyzer, right? This thing here, which is running all day. This is actually running right now on the live account, on this live account that I'm using for demonstration purposes. Again, it's live, it's not sim. It'll give me a theoretical average price right in this box here, in addition to some statistics about my trades and such, so that I can manage the trade. So I don't have a trailing stop or anything. I'm actively managing the trade. A trade that is done, that is complete, and I need to get out of, is one where it pokes through. So I have this nice little impulsive move here. I'm expecting a secondary move. I'm expecting this to pull back, and I'm expecting this 91.50 to be taken out. If it does not get taken out, if it goes 91, say 91.75, and it starts pushing back towards my entry, I'm out. Why? Because of the type of day that it is. Again, the market's likely to keep moving back to the point of control over and over and over. Volume's light, and the market's not directional at all. I am more likely to be trading against other traders today than actually with any real movers of the market. So I'm not going to overstay my trades. I want to unload more than I normally would like to when I'm scaling out, when the trade is working for me, so that I can move my theoretical average or my theoretical scratch price. So I can move that. So I can move that price in my favor as quickly as possible. So if I get the scale out ahead of the IB, my scratch price is up here, so the market would have to come all the way back to this price, and for me to get out, for this trade to basically be scratched, or to give me zero gain for the risk. And I don't like to do that, because I'm taking tremendous risk every time I'm in the market. I would like to get something for that risk, but at the same time, I continuously read what the price action is telling me and how things are trading. So what a lot of people do is, and watching risk and talking to traders all day, at stage 5, I know that a lot of people get passive. What they do is they get in and they set their stop, and the market could sit here and it could threaten it, and it could drop, and it could come back, and there are many, many indications. There could be many, many indications that are saying, hey, this thing is not going to go. It's likely to rotate the other way, especially if it takes out the mid again. Yet they sit there and watch their stop to get taken out. I don't like doing that. I've actually tried to trade that way. I'm not good at it. I don't like the fact that I'm waiting for my stop to be taken, as opposed to actively managing the trade. Now, there's a downside to this. There's a bad side to this. The bad side is, if you don't have discipline and you're not able to execute on what your plan is, then that's a bad plan to actively manage your trades, to not have a set stop, and to mechanically follow your trade management scheme. Does not work for people who are emotional while they trade, or are not disciplined enough to follow their plan. In other words, if you tell yourself you're going to actively manage a trade and you get short and it goes your way, and you're like, wow, this looks like it's going to tumble, let me cancel my order to scale out, let me hold on to this trade, this is big money, I'm going to make all of my losses from last year back in this one trade, or whatever psychological games we want to play with ourselves, then it becomes iffy. Because I've traded for so long, it's not hard for me to stay objective with the trade. Like I can have a position on and still be able to see through the market and not be caught up in what that position is doing. And it takes time. I'm not saying it's a special talent. I'm going to tell you that I have zero talent when it comes to trading. what I do and the fact that I've been doing this for so long has nothing to do with talent. There's nothing innate about what I'm doing. I wasn't born to be able to do this. It's just a matter of continuously looking at and practicing and getting killed on my mistakes over and over and over to the point where you learn it experientially. And I tend to learn experientially, meaning I'm stubborn. Um, and so you internalize it and you get to the point where it's okay. Like it's just once you put on a trade, you can maintain an objective view on the market and see what's going on. For example, as this rotation here, this impulsive rotation here starts to move up and push through and starts to get into the 94.50, this trade is pretty much dead at that point. It may still continue lower, and I will take it again, but the intent for this particular trade does not change, and it continues I continue to manage it per the original plan. I hope that answers your question there, Christian. There are a ton of questions here. I'm going to try my best to get through this. I'm going to do my best to get through this. Timothy's asking, I know you're a big believer in meditation. Which practice do you follow, and are there any materials you would recommend reading? I was just asked about this last Thursday's AAQ by a Stage 5 member. Yes, I am a big believer in meditation, and it's not because of the theory of it or some spiritual thing, like I'm Hindu or Buddhist or something. Not at all. I'm a big believer in meditation because of the experience I've had with it, and the fact that I came from a very a business where I was very, very aggressive and very hot-tempered, and I had a very, very short fuse, and I expected too much of myself and everyone else, and then I had to learn to meditate. I had to learn to manage that stress and that anxiety, and so I went to meditation. And even though it seemed for the first month like I was wasting my time just sitting there repeating a mantra and doing my best to transcend or to go deep, it finally clicked. And when it did, I was definitely a believer from the first time, because it was the first time I actually came out of meditation feeling like I was just completely rejuvenated. It felt like I had gone to bed and had the best sleep of my life and slept for a week to catch up for all the sleepless hours I've had for the rest of my life there at that point. The meditation that I followed was Transcendental Meditation by the Transcendental Meditation Movement, tm.org. It's not the one that I would recommend, though, and they're not going to like me saying that, but it's just too expensive, and it's not for everyone to be able to follow. It's the most structured, but there are a lot of resources out there to meditate. And I got to tell you, I learned through a meditation teacher, so I had to commit to 4 days of spending time with this teacher, and there was a process, and that helped me stick with it. And the fact that it was so expensive caused me to commit to it, as opposed to something that was free or cheap, or somebody I knew taught me, where you just do it and it doesn't have any value because it was free. But I think now it costs like $2,000 or $1,500 or something to learn to meditate, and really you don't need to spend that. What you need to do is commit to a period of time, and this is what it's all about. And I've given this talk on Big Mike Trading and other forums. It's just about creating good routines and good habits, and people have a hard time doing that, with a diet or breaking a smoking habit or drinking habit or whatever. It's all about routine. It's like Alcoholics Anonymous. You follow the same thing. You show up at meetings. You do the exact same thing day in, day out, all the time, and you need that same structure for trading. And My routine is very set. It gets modified over time. I make adjustments to it, so it's not cast in stone. It doesn't stress me out to fall out of my routine, but it's very set. Or I follow it religiously. And when I don't, I generally don't trade, or I trade terribly. Days where I rush to my desk because I overslept or something went wrong with the alarm, or I stayed up late, or those days I've learned to just give up on trading the next day. So the point being, commit to a few minutes of trading, of meditation. At first, it's just like everything else. You don't, just because you want to get stronger and you want to go to the gym, you don't go to the gym and run full sprint for 2 hours the first day. That's going to cost you. It's going to be very difficult to maintain. At first, go for a walk on the treadmill. Set it to the lowest setting possible where you can comfortably have a conversation, and do it for 10 minutes. That's it. The fact that you put on your shoes and went to the gym is a huge step, a huge cue in creating that habit, and you'll feel good about it. And we need to keep that going. So with meditation, my recommendation is to start with someone like Tara Brach, B-R-O-C-H, I think, Tara, T-A-R-A. She has these 10-minute meditations. They're quite amazing. Also, another one is Jon Kabat-Zinn, which is spelled Jon for John. You can grab his listening books or audio books on Amazon. But there's a lot of material out there, and meditation is really about sitting down and teaching your mind to reduce the noise and the conversation. Looks like we're rotating again. I'm expecting 87.75 here today by the end of the session. And that's the goal. Once that noise goes away, you'll find that a lot of awareness comes to the surface. You're calmer. You're operating from a much stronger state of mind. You're able to take on a lot more stress. As long as you keep watering the root, as they say, as long as you keep coming back to meditation, you'll find that your meditation sessions are going longer and they're deeper and more fulfilling. So with trading, with life, with any routine, as you would expect, it is really important to do things one little step at a time. And most importantly with this stuff, do something good for yourself, something small that's good for yourself every day, if you can. Don't try to do it, just do it. Drink an extra glass of water. Treat yourself to something small that you would like, that you have earned through your effort today as a trader who's achieved his goals or her goals. But treat yourself to do something just for you, small, once a day, and that those small things add up to big habits over a period of time. So if you're thinking of becoming, athletic or becoming thinner or whatever, just start small. Cut something out. Instead of a full bowl of cereal, have a half a bowl of cereal. Instead of cutting out your soda habit and you're drinking 4 cans of soda a day, cut it down to 3. You won't feel the difference that much, but it makes a huge, what you're building is emotional capital. We do the same thing in trading, by the way, when we're teaching someone in prop. In prop, for the first, as soon as you learn the background and technical aspects of the market, the next thing in prop that you have to learn is to just do as you said, to just do the right thing. This is what we want, and we want to reward that. So the goal becomes to build emotional capital. It's very important to be able to trust yourself. I can get short here, even late. I can drop into the market and get short at any point, but I trust that I will be able to manage the trade properly, that I won't panic out of it, or I won't hold it to a massive loss or anything like that. And that's because I keep a high emotional capital. I trust that when I come in here, I will follow my plan. I will do well for the day. And if the day doesn't pay, it doesn't pay. It doesn't guarantee me an income that day. But the overall edge that I have is that I'm continuously maintaining that emotional capital, and meditation helps that a lot because you're getting down below the surface, and treating yourself to something, that's going to build those habits and build that emotional capital. That's Timothy. David, I see you moving across various time frames and conducting your analysis. Is there a reason or rationale for when to use a specific time frames? Okay, so on this chart here, this handles this screen, and I show it during the Trader Bites and stuff because most people trade the most popular product is the ES, although I don't feel like it's the best product to learn on. It's a little more difficult, I think, a little more competitive to learn on than other products. But overall, I have 3 time frames in here. I have a daily time frame. This is an RTH only composite chart. Whoa, what happened here? There we go. An RTH only composite chart. I have a 15-minute chart, a bar chart, and I'm only using a 15-minute bar chart, although I don't like using time in my analysis. I feel that time throws things off. I'm using a 15-minute bar chart just to be able to see what's behind today for a few days. It gives me a bigger picture. So this is the chart that I use to decide how the auction is going. What are we doing relative to yesterday or relative to a much earlier day? I'm able to see into last week here, into a couple of weeks. This is what the 15-minute chart is for. It's for a bigger picture analysis and to make sure I can verify and establish context. But this is my trigger chart. As soon as I've decided that I'm going to get short, this is the chart that comes up, and it's the chart that I trigger off of. It's a 2-tick Renko. So those are the different time frames that I'm using, and I need to look at the different time frames to just verify that there are no obstacles in the way, that I'm not overlooking something that really should be obvious. Okay. Al is asking, do you have your setup for Sierra chart? Can you share it? I do not, Al. I don't use Sierra chart at the moment, so I don't have a setup. But if someone out there has a similar, and I think several Twitter followers do have a setup that look like this and would like to send it to me, email it to me, I'll be happy to make it available to anybody who wants it. Prakash is asking, and I know you wrote to us about this, delta on your charts, is there an equivalent indicator for TOS, Thinkorswim? I have no idea. I have never used Thinkorswim. It's a retail platform. It's definitely not something I would recommend for futures trading, although I know why people use it. It does give you access to various things. But I don't know if they have a delta for Thinkorswim. I'm using it on IRT here, and it's very accurate because the data feed I'm using is unfiltered, and it's an IQ feed data feed, and I trust what it shows me. So I'm not sure what the answer is to that question. I would suggest, if you're going to trade futures, I would really suggest you complete the process with stage 5 or move to a direct market access platform. And there are many, CTS or XTrader or whatever. Vernon is asking, can you tell me your setup? What are your candles, time, Renko range? I've heard that there are 2 types of market profiles. Which do you use? Vernon, just as a background, I'm being told, by the way, Prakash, that TOS does not have a delta. They don't have that indicator. And it's been important for the last few days because we see the higher time frame interacting with the market as it drops, and it's set up quite a few things in the last week or so. It's been in the forefront to watch what the delta is doing. Back to Vernon. I'm using volume profile. I started out with market profile. This is what market profile looks like. It's 30-minute brackets broken down by a letter, and it's stacking those letters in 30-minute brackets. This is where I came into this, but I moved away from it because I had access to volume to tick data, and I could see the volume rather than breaking everything into a 30-minute bracket. And as I explained, this is a 15-minute bar chart, candlestick chart. This is a 2-tick Renko chart. The Renko chart, the reason I use Renko is because it's cleaner than a regular candlestick chart. It does not create a bar if there isn't enough movement. You can also use a range chart for that. Hans is asking, can you please discuss briefly Renko bars and why you prefer them? I think I just answered that, Hans. It's because they tend to keep the price action clean. They're not restricted by time. But before Renko, I used a 2500 volume chart in the S&P, and I think in the Nasdaq and oil I used 500 and 700. It doesn't really matter, to be honest with you. It doesn't matter. It doesn't matter what, as long as it's the chart's giving you the information you need for your time frame that you're trading in. It doesn't matter what you use. Travis is asking, is market delta the same as up-down volume ratio? Market delta is market delta is a product. But this delta here, delta describes the difference between the relative difference between two things. So delta is used in options, and it's used to measure. It's also used here. A delta is I refer to it as a delta. It's because it's measuring the volume of the aggressors on the buy side minus the volume of the aggressors on the sell side. So all this is doing, it's called a volume breakdown indicator on IRT. All this is doing is it's telling us that since the market opened this morning, there are 1,749 more buyers on the offer than there were sellers on the bid. That's all that's saying. It's how many people cross the market to buy minus how many people cross the market to sell. And there are many ways to represent that information. Okay. Brandon, my mentor has always told me to implement a 3 strikes rule for consecutive losses, but I have issues following this rule. Are there any ideas? So Brandon, I put out a trade wisdom segment last week. You can just go to my Twitter, FuturesTrader71 on Twitter, and you'll find a link to it. And it talks about, it's about actionable discipline. Your issue, knowing that you should be implementing a 3 strikes rule, which is something that I've used. I'm not sure who your mentor is, but it's something that I've used in my prop and for my own trading. The issue, if you cannot follow it, is multiple. There are multiple issues there. The main one being discipline. So discipline is a funny thing. It operates, just listen to the video, I talk about it. Discipline operates like a muscle. You can get discipline fatigue. But the issue you're dealing with is the reason I started stage 5, and we do our best on a best effort basis. We do our best to control how traders behave when they are live in the market and are losing. That's really the main thing that I provided as a service to my traders, prop traders. Yes, I provided the capital, but the biggest thing I did for them is I turned them off. I shut off their ability to trade, because once you're caught up in the fight, you're not able to be objective about the fact that you probably should stop, that you are not in alignment with the market. You're splashing around all over the place and hurting yourself in the process. People don't see that until it's too late, oftentimes, in my experience. So the fact that you have a rule that you're not following speaks to deeper issues. And the issue is that, one, you don't trust the rule. You don't believe it's a valid rule. If you did, you would follow it. If I came to you and I said, here's a parachute, put it on, because we don't know when this airplane could go down. And if you have resistance to it because you feel like, it's I don't want to put it on and sit and it's uncomfortable or whatever. But I bet your confidence would be a lot stronger once the airplane shakes a little bit. And now you're a true believer in the fact that the airplane could crash. And I'm here to tell you, Brandon, that you could crash. This is a leveraged market. Most products you trade are leveraged, especially derivatives, be it FX or any derivative options, futures, single stock futures, things like that. These are leveraged products, and it's very, very easy to lose your entire account. You look at the average trader is probably trading a $5,000 account, online trader, probably trading a $5,000 account or so. Somebody who's not seeking to do this professionally but is dabbling in and wants to make the transition. Most people don't put very much into their trading account. And at most brokerages, that trader may be trading for $400 to $500 margins in the ES. That means that the market only has to move a tiny amount to destroy that entire $5,000. It could be gone in a day very, very easily. For $5,000 and $500 margins, you could trade a 10 lot, and a 10 lot doesn't have to go very far to wipe away $5,000. And so if you're not, while you're in the trading, while you're in the heat of battle, you are not yourself. I recommend you read The Chimp Paradox, a really good book about this. You are not yourself. And so if you don't follow that rule, you're essentially allowing your emotional part to take over. And I can tell you, any decision you make emotionally in trading is likely to yield poor results over time. And so the 3 strikes rule is something that I do, even though I've been trading for a long time. It's something that I follow. It's saved me. It's cost me on some trades or whatever. I've stopped taking a trade, and then all of a sudden I see the market rip in a direction that was expected. But who cares? In the long term, it is saving me from myself. And so it's best for you to start following that rule and whatever other rules you've created. Now, you don't have to listen to me because I know you think you're special, as we all do. We all think we're special when we come to trade, and we're going through the 4 stages of competence. You just have to let the market show you. And eventually what happens is it'll sink in. Either the market makes it sink in, or you have an epiphany and you decide, I need to obey that rule, follow my rules, and commit to my plan. And that's the biggest issue, is that you're not committing to your plan. So the results that you're after are late, and I'm not picking on you or anything. I'm just speaking from many dozens of traders, experience with many dozens of traders. I'm just letting you know because it's what I see coming. I call new traders who sign up with us, and I tell them, hey, you got to come up with a daily limit. And those who say, I'm all right, you don't need to bother me, I'm fine, I know what I'm doing, those guys get added to a different screen and get watched more carefully, because those are the guys that blow up. Eventually the market catches up with them. So you need to look at this as a business and to really follow what you said you'll do, just like you would on a normal business. Let's move on. Wow, these are tough ones. How do I know when a stat is not going to play out? You don't. But statistics like, the IB high, the IB being broken, is 97% of the time the IB high or low is broken, IB high or low. 98% of the time, the overnight high or low is touched or breached. Those are fairly easy to see coming. Other statistics like day type, the potential day type and things like that, like we have a neutral day today, 35% probability over a 1400 day sample. Those types of stats are hard to see. You just have to wait for the day to play out. Those are not boulders, though. I'll just say that you cannot know what's going to happen in the future. You can only bet on the stat if it's high enough. I'm going to go to a mic request. I just saw it. Jeff, hopefully you're still around. Jeff, you're on the air.
Hey, FT, how are you?
Good. How are you?
Good, good, good. Yeah, I dropped into the webinar about halfway through, so I don't know if you tackled this. I actually have two, but I'll try to keep it simple and short and to the point, and if we get to one, we get to one. So I'll start off. So the first one is, and I'm not a newbie at this, and I've talked to you before. I'm not at stage 5, not yet, but I follow your methods almost to a T, with a little bit of my own style mixed in. My major question now, and this is somebody who has a plan, I've put stats on basically my setups. Just give me 1 second. And I've gone through setups and statistics and a lot of other things, and I think I'm at a point. Although I know it's going to mess with my mind and my mental, just my mental focus. But at what point does somebody really address the issue of adding size? And I know, again, it's probably, well, I don't know that it is, but an issue to, work around, because there's a lot of people that may not. But for somebody that's committed, that has a plan, and is having success, at what point, and what would be a good way to go about adding bigger size to the unit size traded?
Okay, great question. What's your expectancy? What's your expected value?
I don't have that. You would think that I should. I know almost everything but that, and I did have my expectancy of a sample set probably 6 to 8 months ago, but I'm not Excel savvy. I've gotten spreadsheets from other people, but I have like a win-loss rate. I know what I make per trade. I know what I lose on my losers and things like that. I guess I could figure out my expectancy.
Okay. So this is my opinion, and the goal, again, as a prop shop guy, my goal is not only to hire the best possible candidate I can find. My second goal is to make them as profitable as possible. And so there's a push, there's pressure, so to speak, to not only help someone make the turn, but as soon as they do, to promote higher size or larger quantities as quickly as possible. And the way to do it, so the first question is, how do you know when to increase your size? You know when to increase your size when your expectancy is stable. And that could be, your average expectancy can also be expressed in how many dollars per trade do you get on average. That's also an expectancy. And if that's a decent positive number, then what we look for is to push to increase size progressively. So if you're trading a 1 lot, going to a 2 lot opens up a whole world of different opportunities, because now you're not binary anymore. It's toughest to trade a 1 lot. It really is. But if you're in a 2 lot, then the normal habit is to say, okay, are you bored? Do you come in expecting to make money on that 2 lot? After a while, it just becomes, you start to feel like, man, it's really dumb for me to trade a 2 lot anymore. It just feels like I can do better with this. And that's really when you're ready. It's more of an emotional or confidence-based decision, although it is very much statistical. But for most traders, I don't go around, telling them that I'm monitoring their statistics. I just ask, how confident are you when you come in tomorrow that you can do something with the market, no matter what it gives you? Yeah, I'm pretty confident. Actually, I've been rocking it. I've been doing pretty good. Okay, then tomorrow, come in, trade your 2 lot like you normally do, put up credit for the day, meaning put up some wins, and then we'll add a third and see how you handle that third. And don't change anything. Don't change anything. Don't change your trade management scheme. Don't change anything at all. So even for myself, when I went from equity scalping to future scalping, and then I started to go from future scalping to actually taking a stronger position in the market, what I would do is just come in early and put up, a certain amount, like $1,000 or something in the DAX. And then I would switch. I would increase my size. I would go from trading a 3-lot to a 4-lot, let's say. And if I lose that $1,000, I go back to where I started. And most days I just stop because it just tells me that I'm not in alignment with the market. But you want to do this gradually, and you need to have a plan. Like, you need to actually sit down and write a plan. What do we put on a plan? We always say I need to have a plan, but nobody ever tells you what to put in it. What you need to do is write down exactly how you'll approach it. I expect to come in and win and make a gain for the day. And so on most days I make $300. So once I have $150, I'm going to add another contract. And if I give away the $150 because, I'm getting emotional or I'm getting afraid or it's getting to be too much, then I'll go back to trading the size I normally trade. And you keep doing that. And it takes people about, I would say, I don't know if I remember correctly, like 3 to 4 sessions of doing that before the higher size becomes the norm. Because they start to see the returns multiplying. Like, if an average day for a trader is $600 net, and they added a 1-lot, and now they're seeing $800,000-$900,000 days, fairly commonly. They want to start trading that bigger size right from the get-go. But you don't want to change other things, because the goal is to keep your statistics as firm as possible while increasing size. In the ideal world, as you get bigger as a trader, your goal is not to become the person who catches the low of the day long and then gets out at the high of the day. That's not the goal. The goal is to trade whatever it is that makes money, however you do it. Fibs, MACD, CCIs, whatever, patterns, floor pivots. It doesn't matter to me. I'm impartial to any, dartboard, the dartboard method, moon cycles, whatever. It doesn't matter. As long as you can consistently replicate that, and then you're in a market that is liquid enough, then your goal is to just do just that, become the master of whatever it is that you do, and then just increase size incrementally, but also mind your risk. Like, you just because, just because you're a little bit bigger. Hey, Jeff, is moving from 3 to 4 lots. Man, he's got this whole thing figured out. He's a master of the markets. Heck, he should start a chat room and start charging for it or whatever. Now your ego is getting in the way. Now your losses are going to be painful. Whenever your emotions, ego, and so forth come into play, you need to back off. If the market's pissing you off and it's not doing what you want it to do, it doesn't have to do what you want it to do. And when you're a surfer, the waves don't have to follow exactly your paddling speed. They don't have to give you anything. It's your job to ride the waves that you have coming. And some days you'll just float around for a few hours and nothing comes along. And so you swim to shore, pack up your stuff, and you go home. You don't sit there and throw your board at the ocean or make fists at it or punch it. It makes no sense. This is the market. It's just a huge ocean. And our goal is to align ourselves with it. And as you grow bigger, all you're doing is becoming confident enough to go out there and ride bigger waves for bigger returns. That's all. And if you get yourself in trouble, back off. Go to your bread and butter, cycle. Go to your normal habits and ease into it back and forth. It's not, okay, I've got this figured out. I'm doing pretty good. I'm hitting my targets. Let's go to 20 lots. And I used to trade 2 because I want to multiply my stuff by 10. Multiplying your size by 10 increases your potential for emotional catastrophe astronomically. Probably it increases it by 1,000 times. It's just, so you have to do this surgically and slowly. So your plan needs to say, here's how I'm approaching this. This is when I can increase my size. This is when I have to back down. And this is what I'm doing the day after. If I hit my limit, that I'm going back to my original size for at least 3-4 days to build up my confidence. It takes a while to build up your confidence. Then I'm going to try this again. And you'll fall, just like learning to ride a bike. You will have to fall. And you just have to fall gracefully. There are people who just will not let go of the bike until they smash into a wall type of thing, So does that make sense, or have I lost you in that?
No. Makes perfect sense. And
incremental gains. Okay, so incremental changes, incremental gains. It's a delicate process. And it sounds like frooey and all that stuff, but it really is. It's as you're doing worse, I see most people starting to pile on more. They think it's a Monte Carlo simulation or something. That's the wrong way. If you're doing something wrong, doing more of it bigger does not improve your results. That's why adding more capital doesn't make sense in those situations. Although as a broker, I'd love for our clients to add more capital. A lot of the time I tell them, nope, don't add capital, go to sim. We don't get paid on sim, we get paid on live trades only. But that's what's best for them. And in the long run, this is what we want to build. So the same for you, just do it incrementally. The goal is for you to be here for the next 20 years, for you to retire on your gains from trading. And it's possible. And anybody who believes that it cannot be done is right. It cannot be done. If you believe it, then it's right. But if you believe that it can be done, you're probably right because you believe it, So it's just you get what you put out there is what I'm saying. All right? Just do it slowly.
All right. Thank you. Very good. Very good. Thank you.
Thanks. Let's see. Another Jeff. If you're still here, Jeff Z. Jeff, are you still with us? Jeff? Jeff Z? Jeff Zamuda? I see you playing with the mic. I can hear you. Oh, you're really, really far. Something's wrong with your microphone. I'm going to put you back on mute until you sort that out. Just drop me a note when you're ready. Question by Lana. Lana's asking, if you had only one other indicator to watch with VP with a volume profile, what would it be? One other indicator? I would say probably, since I can compute pretty much anything else that's on here, the mid and so on, I think it would probably be the delta. The delta gives me an idea of how aggressive one side is over another, this line here. And it's hard to see right now because it's including yesterday's range. But I would say the delta. Everything else, the mid, this line here is very important to me, the mid. Pretty much everything else I can compute. So Dan is asking, how much weight do you put into the Globex profile? Good question, Dan. So the Globex profile just tells me how the market responded to either the Asian or the European session. I look at it in the morning. I don't trade off of it. I don't trade a 24-hour chart. I'm still more interested in what happens when the 500 stocks are trading, and this applies to equities. This does not apply, for example, to the Euro futures. The Euro futures have a cash session all day long. With the Euro futures, what I do with a currency future, what I do is I break up the day into when the main desks are picking up that currency. For example, if you're trading the Japanese yen futures, you need to create a session for when Tokyo opens. Very important. It's their currency. And you need to create a session for when London opens. And you need to create a session for when New York opens. Break up the day that way. And I would use all of those sessions combined. So I would have 3 profiles per day, but I would also have an additional profile that combines all of them, which you can do in IRT. But for something like the S&P or the NASDAQ or whatever, I know the equities underlying these do not trade at night. Really, there's not much volume. But I do pay attention to how things are laid out. It gives me an idea of how Europe and Asia traded and what kind of day I should be expecting. This is why today's hypo was favoring the downside because of partly because of the way the overnight profile is shaping up. And we haven't really accomplished our target for hypo 1 down at 87.75, but we've pushed to 90.25, and the idea comes from how it traded overnight. It sets up the day a little bit, but I ignore it once I look at it, once I have an idea of what it's doing. I mean, you look at last night's overnight session, 186,000, even though it's a fairly active session. By the time we're done normally with the S&P, we will have traded 1.1 million contracts. So the entire overnight session, which is longer than the day session, only trades 10% of the entire day. So I don't put much weight on it, but I can tell you that over time it does become more and more important. There's going to be more and more volume coming in on the overnight, and the Globex or the entire session becomes more and more tradable over time. But as of right now, the stocks that underlay the ES and the NQ and the Russell and the Dow and so on, those equities, I'm trading a derivative of those equities, and those equities trade during day hours, stock hours, and so I keep everything on my screen as regular trading hours only. I've got many more questions here to cover, but unfortunately, it's been proven that you lose people's concentration after an hour. So I need to respect that and let you go. I want to remind you that I'm off starting tomorrow till the 31st. No trader bites, no webinars for our S5, Stage 5 folks, and so on. I'm off until the 31st, and I wish you the best of luck. But thanks for joining today. I hope you found this useful. The recording will be out. You will get an email from Stage 5. It's not a solicitation email of any kind. It's just your copy of the recording so that you can review it at a later date if you wish. Okay? Thanks for coming in. I appreciate your time and the fact that you came in. I'll talk to you soon. Good luck on your trading. Watch your risk. Watch your risk. Okay? Take care.